Hello, listeners. We wanted to note that today's podcast will not address the recent strikes in Iran and the recent Big Beautiful Bill. Our focus in this episode is on market resilience, shifts in market leadership, and how important strategic positioning can be amid changes. We hope you enjoy. Hello and welcome to CIO Perspectives. I'm Sid Ahl, the Co-CIO of Private Clients here at Brown Advisory, and I'm joined today by my co-host and co-CIO, Erika Pagel. Today, we're excited to have our colleague, Sargent McGowan, the CIO of our Endowments and Foundations business, who joined us last year from the University of Virginia's endowment, UVMCO, following a career in equity research and portfolio management. Despite a long list of concerns, stock markets have recently approached new highs, and thus far, both the economy and markets have remained relatively resilient. So maybe, Erika, we could start there. What do you make of this market resilience in the face of so much uncertainty? Kind of feels like in some ways, we're back to where we started the year. Stocks are up, interest rates are in about the same place. What's going on?
Yeah, Sid, I would agree. I mean, it's been quite a year already. And just looking at the equity markets, 2025 so far has just been this year of great rotation. There's just been this trifecta rebalancing across asset class, style, geography, and valuations have played a role. Dollar weakness has played a role, but tariff uncertainty has been the primary driver of these abrupt swings. So following a long period where tech and the Mag 7 led the way, we've finally witnessed some market broadening. There's been this international appeal for the first time in years. Europe's up more than 20% year to date. China is up close to 20. Value's still outperforming growth, but lo and behold, we had a growth rally quarter to date. It's up roughly 14 or 15% so far this quarter. We've actually had many sectors lead so far this year. At one point, energy, industrials, tech, healthcare were all at the top of the S&P stack. Today, it's utilities and financials. So it's been a really long time since we've had this much variation in sector leadership. And so stocks are climbing this wall of worry. And we've seen this 20% or so lift off from the bottom in roughly 8 weeks. So why the bounce back? First, trade truce and earnings have helped propel the market from lows. The markets are effectively saying that worst case scenario, recession, is probably off the table. We've seen this U-turn in tariffs where the hope is that negotiations are successful. We don't really know how much tariff revenue will be, but estimates are that there will be enough to offset the potential increase in the deficit from proposed policies. Second, tech and earnings are really saving the day. Tech has contributed roughly 60% to earnings growth over the past 5 quarters. The launch of DeepSeek and its cost efficiency really put this magnifying glass on US AI spend. And those fears were pretty much unproven from mega cap earnings. And we really haven't seen that pullback in spending. We haven't seen tariffs show up in the data yet. Inflation's come in much better than expected, CPI and PPI. We don't have much flow through from tariffs yet. We've got the 3-month annualized inflation that's now below the Fed target. One thing that we are watching is services and manufacturing. The ISM index did go into contraction. So new orders are down. Inventory storage capacity is high. How much inventory is there? It's really hard to gauge. Coming out of COVID, many companies did start to build inventory some, a couple months. And then there's estimates that companies were able to pull forward a couple weeks of inventory. So it's really no surprise that we haven't seen the tariffs show up in data as of yet. But there's definitely higher costs to hold this inventory, and warehouse capacity is pretty tight. And then we have the Fed, and there's a lot of moving parts right now. The Fed's in this holding pattern. It's a lot more complicated today. Slowing growth, higher inflation, the labor picture is complicated when considering the impact of immigration and recent layoffs. And this wait and see mode by the Fed is much more in line with a slowdown than a recession right now. So where are we today? It's still an environment where tariffs and fiscal policies are the key drivers of the market. The range of outcomes has narrowed. Inflation's expected to increase. The Fed is moving slowly. And you mentioned this, we're kind of back to where we were at the beginning of the year, but there's definitely some things that aren't as good. I'd say that one of the biggest things on our mind is supply chain. Companies have really leaned on optimization to drive corporate profitability over the past several years. So any disruption to the supply chain could be a direct hit to margin. So that's something that we're watching in future earnings calls. But the good news is we've seen S&P 500 earnings revisions come down from double digits down to high singles. But at 22 times forward earnings, given what we know today, there's a lot of complacency that exists today. And we could continue to see this broadening outside of US large cap. Sid, what's on your mind? You've done a lot of work on AI and the impact and investing in client portfolios. How are you thinking about AI in the markets today?
Well, maybe I'd first start with a discussion that follows on your economic discussion, a big shift, right, in the economic growth outlook at the moment that Trump came out with the placard and we had Liberation Day tariffs across the board. I think, before we had the pause, there was the chance, 80, 90% chance of a recession. We've obviously come back much more into normal recession odds as there's been a bit of a U-turn there. So job market is still softening, but we're still coming off of, I would say, a historically tight labor market post-COVID. So I think we should expect some kind of economic slowing in the second half. You're right, stock market valuations do appear elevated relative to history. I still struggle a little bit because the largest companies in the market today are so high quality, they're kind of unrivaled in quality and growth. You mentioned tech is driving 60% of earnings. It's just so rare to see large companies growing faster than the rest of the market like we're seeing today. And I guess that leads me to this discussion on AI. It's probably the biggest thing on my mind. There are a long list of concerns today, but one real positive that I've seen is the acceleration of AI adoption this year. So a few quick statistics. AI token usage, and tokens are basically a measure of how much data is being consumed with AI models. The token usage is up 6 to 7x this year. And it was up 40x last year. So we're seeing enterprises and consumers are using these models more and more. ChatGPT is the number one app. It's been the number one app for many weeks running, months running now. And more companies are seeing real use cases for AI, and that's including Brown Advisory. The rate of growth for this token usage has more than doubled this year versus even the end of last year. So why is this happening? The pace of improvements in the models appears to be accelerating when you look at the complexity of tasks that AI can complete, as well as the developments around models being able to link directly to applications through APIs. We appear to be getting closer to this idea of AI agents that can do more than just answer questions. They may be able to complete tasks across multiple systems. So as an example, reviewing an invoice in your billing system and then validating the data in your CRM system, making a payment, and then sending a confirmation via email. In particular, we're seeing a really big jump in AI being used to write code. So Microsoft recently said that 20 to 30% of their code is being written by AI. The leading AI coding assistants, including Microsoft's GitHub, have more than doubled revenues this year. And there was an interesting statistic I just read that in Y Combinator's latest batch of startup tech companies, about a quarter of them used AI to write essentially all of their code. So I'd say I'm getting more optimistic about the sustainability of spend on AI infrastructure. And this has been, as you mentioned, confirmed by the big tech companies publicly. We're now approaching 10 billion of revenues being generated just from the model companies themselves, like OpenAI and Anthropic, and fast rising revenues from the coding applications and other areas. Clearly, the hyperscalers are using AI in advertising, search, and driving growth in their cloud businesses. So I think this is a positive for investments in our companies like TSMC, NVIDIA, Broadcom, and other semiconductor companies, as well as the energy and infrastructure companies like Talon, Constellation, Siemens Energy. It would also be good news for the cloud providers like Microsoft, Amazon, and Alphabet. It could prove to be a positive for enterprise software companies that are able to upsell AI-powered products, and we're starting to see signs of that. And I would also note we're continuing to see signs of labor force cutbacks in tech. These tech companies are the earliest adopters of AI, and they're clearly generating increasing productivity by using them. So I am broadly optimistic about the potential productivity gains that we would see across tech and other industries. And that's a bit of a counterbalance to some of the macro uncertainty that we face. I think one can argue that some of the recent stock market strength, obviously, some of it is just this U-turn on trade, but some has to do with these improving fundamentals within the tech and AI ecosystem. Since the market bottom in April, the Magnificent Seven is up 32% versus 20% for the S&P and 20% for global stocks. So my last point is the shift of capital out of the US. You mentioned it. It's definitely on my mind. International stocks are outperforming the S&P by 15% this year. The dollar is down 8%. We have long argued for running global portfolios and having 30 to 35% invested outside the US. I would say despite this run in 2025, valuations abroad still seem supportive of that stance. The US dollar still appears overvalued, and we have a government that's actively trying to close that gap. And we're continuing to see some of our non-US clients asking us to reduce exposure to the US, both in terms of their investment portfolios, their banking activities. And this is because of some of the regulatory uncertainty, including potential additional taxes on foreign investments into the US. So I think this change in sentiment and flows is real, and it could be somewhat lasting. But I do think if we continue to see this leadership out of US tech and AI, it'll be hard for foreign investors to stay away from these leaders. So there may be some limits to how extreme these moves might be, and it might be played out more in the currency markets or fixed income markets. But this is probably a good time to bring in Sarge. Sarge, welcome to the pod.
Thank you. Great to be here.
I'm curious what you're thinking about today for endowment and foundation clients and their portfolios. It's a time when you're also seeing some funding and political pressures at the same time as all these market dynamics we've been talking about are playing out. What's on your mind?
Yeah, a lot. Maybe starting with what we're hearing from clients on the endowment and foundation side. We spend a lot of time with our clients. We spend a lot of time listening and trying to understand some of the issues they're facing. And I think, Erika, particularly some of the topics you talked through, these are policy initiatives that are impacting these organizations and not necessarily from an investment perspective. The tax bill is still being worked through. There are some pretty big increases in tax rates for certain endowments and for foundations in the House bill. Those have been reduced in the version that we've seen so far in the Senate bill, but we don't know what that will look like ultimately. These could impact our clients and similar endowment and foundation groups. Cuts to federal funding have been a big topic as well with many of our clients. And even if some of these clients aren't impacted directly by moves and initiatives on the policy side, the constituents that they serve may be impacted. And so there may be things that they need to do. They may need to increase their spending to meet some of these needs. And so we are seeing a lot of uncertainty that these groups are just facing. And on the investment side, what we're trying to do with them is just make sure they have the cash and fixed income on hand to be able to deal with whatever they will need to deal with. Our typical rule of thumb is to have 2 to 3 years of spending needs in liquid cash and fixed income. And we're running scenario analyses with certain clients on this just to understand and be sure that they have sufficient liquidity. I think it's also a really important time for strategic advice. And this is another service that we're providing to these clients through our strategic advisors. And I know that's been something they've very much appreciated in a time like this when there's so much uncertainty around how to kind of navigate some of these organizational issues. More to the investment side, I would pull all this up to the level of how are we going to meet our long-term return targets? So we've got higher valuations coming into the year, as you both mentioned. We're kind of back to where we started. Markets up a bit from here through the year. And if you think about a typical endowment or foundation, you have a 5% spending rate, a few percent for inflation. You probably need to generate something in the order of 7.5% in order to maintain the value of that pool of capital long term. Our work internally in looking at long-term returns for different asset classes suggests that a passive 70% MSCI ACWI, 30% ag portfolio won't get you there and get you closer to maybe 5.5 or 6%. And so some of the things we're stressing with our clients is that continued reminder that diversification matters. Sid, as you discussed, there are pockets where we do see better value opportunities and also the need for active management and good active management. On the global side, we're really looking to also be sure that our clients are invested across international markets. We have a fair amount in Europe. We have some exposure to Japan and have built that up a bit more recently. So we are maintaining this global exposure in portfolios for our clients. We're also looking for sources of return where we're not necessarily taking a significant amount of underlying market risk. So hedge strategies, whether that's traditional hedge funds or more diversifying hedge funds that have quite low beta and can generate alpha and excess returns in ways that don't rely on market risk. In fact, that can be an important part of asset allocation in a time like this. Private equity is another one that we continue to use for our clients. And the last thing I'd say here is just reminding our clients and just continuing to keep a long-term focus. It is very hard in markets like this. The news changes daily. Tariffs were on, they were off, they're on, they're off. We've got a big date coming up in July when that 90-day break expires. And it's easy to get caught up into the noise of some of these changes. What we're trying to remind our clients is let's build an asset allocation plan together. Let's recheck it in periods like this and make sure that those assumptions are still good. And then let's make investments that we think can add value over time, and let's stick with that. So that's really what we've been spending time with our clients. Sid, maybe I'll kick it back to you. How are you thinking about hedged or leveraged strategies in this market?
Well, first, I would say I love your commentary on trying to keep a long duration outlook in a market like this. It is really hard. And so making a plan and sticking to it rather than reacting to all the headlines, I think is incredibly important. But to the question on hedge strategies, leverage strategies, I think they're very important. As you noted, right? If you just have a global stock, global bond portfolio, it's pencils out to not meeting the needs of your endowment and foundation clients and many of our private clients. So what are ways that we're using them? One is what I would call passive plus. So this is an index-like return, adding something on top of it. So for taxable clients, this is things like tax loss harvesting extension strategies, where you add a bit of leverage in a way that you're not taking any more market exposure. So you add, say, 30% more long exposure, combine that with 30% more short exposure. That increases the tax losses you can generate. And you could also generate some excess return on the investment strategy that is being used to pick that 30% long and 30% short. We have been very big utilizers of that in the last few years. For non-taxable clients, you can use alpha extension strategies, basically adding a little bit of extra long and a little bit of extra short on top of, say, an S&P 500 or a global stock index to return above the benchmark again, and give you a little bit more of a degree of freedom in terms of the active decisions you're making on smaller companies. If you don't like a company that's 20 basis points, 0.2% of the index as a long only manager, the most you can do is have zero exposure there. If you have a long short strategy, you can choose to have a larger negative bet on that company and be 1% underweight rather than 0.2% underweight. And then the second way we're using strategies is what you mentioned, these kind of market neutral diversifying strategies. So I am a firm believer that diversifying hedge funds are an important element to portfolios because they aren't correlated to stocks or bonds. So they can reduce risk and increase returns if done well. And in this period of time where bonds have not been serving the typical purpose of protecting when the stock market is going down, I think it's an important way to diversify portfolios. We saw it in 2022 in the extreme case, but even for a minute there in April, we had some times where stocks were going down and bonds were going down. So we are believers in building up that core bond portfolio, but I keep a bit of room for these diversifying strategies, even in taxable portfolios, to add that element of diversification. Erika, I can kick it to you to talk about small caps. Small caps have historically been one of those areas of diversification and also return enhancement. The space has been quite tough this year. What are your thoughts on the setup for small caps?
Yeah, Sid, it's hard to have one of these conversations and not talk about small cap over the past couple of years. Yeah, this is a really tough one. It's a pretty painful return story for more than a decade. Small cap outperformed large cap back in 2020, but the last time you really saw this annual notable outperformance was actually in 2016. There was some reprieve and better returns post-election when small cap rallied on the hope of a US-centric policy, lower taxes, deregulation. The good news is the Russell 2000 has rallied off of its bottom, similar to large caps and international since April, about 20%. But overall, small cap is still negative on the year. If you go back 5 years, mega cap cumulative performance is in excess of 130%. Small caps is about 40%. And if you go back a decade, small cap returns have basically halved those of large caps. So what's going on? There's a lot of headwinds in this environment. There's structural challenges. We've had less IPOs and acquisitions over the past few years. Small caps are much more cyclical than their large cap friends, given the heavier exposure to sectors like real estate, financials, industrials. And then you've got 40% of the benchmark that is unprofitable. And investors have, given everything that you talked about, earnings growth coming from mega cap tech and AI, investors have favored that growth of large cap. And if you look at the Russell 1000 growth, it's been the top performing asset class in 6 of the past 10 years. And then something that is, I think, most on an investor's mind is fear of a recession, but just the higher leverage that comes with the Russell 2000. So small cap debt coming due in the next few years is higher than the past. If you look at large cap, consistently around 10% rolls over on an annual basis. Small caps are probably going to be mid-teens for the next couple of years. So that sensitivity to interest rates is higher. So why do we like small caps, given all those headwinds and challenges that are impacting the space so far this year and over the past couple of years? Number one, Sarge, you mentioned pockets where there's attractive value. So valuation is attractive in a lot of areas within this asset class, roughly a 20% discount or so to 20-year averages. So you really get this diversification at a discount. But Sid, you also mentioned this is an area where active management can do very well and add a lot of value. So this is an area where you can actually generate alpha, where if you go and look at the large cap space, there's been negative alpha generated by a lot of managers there for years. We like the exposure to more underloved parts of the market right now, like financials, value, and cyclicals. There's a lot of mispriced companies in this universe, a lot of companies that are not followed by the street. There's been a lot of analysis out there looking at quality and valuation. So if you look at the top ROE or return on equity generating companies in small cap, they're at 1 to 2 times sales. Some of them, non-earners, are double that, a 4x multiple on sales. We're starting to see that pick up in M&A activity. There's a lot of deals being done that are much more middle market or less than a couple billion. And if the US manages not to go into a recession, if the Fed should cut rates ultimately at the end of this year, that should bring relief, hopefully, for small caps, just given that sensitivity to interest rates. And then, the street is hoping that there is some improvement in earnings growth later this year. So with putting that all together, we do see a valuation opportunity here, recognizing that there are headwinds. So how do we think about sizing of small cap in portfolios? Small cap's roughly 10% of the US equity market cap. That's a starting point. But, we would highlight that we have reduced our small and mid cap exposure to fund an investment in Japan over the past couple of months. Within US, in small and mid cap, we're leaning value. We like core strategies. We like the S&P 600, which tends to be higher quality. So roughly 20% of that index is unprofitable companies. We like managers that are looking at free cash flow yield. We've allocated to long short managers, just given the volatility in this space. And we've used small and mid cap as a proxy for privates. For clients that are building their exposure to private markets, we've utilized this asset class to fund capital calls.
Sarge, what do you make of the situation in small caps today? How are you utilizing?
Yeah, very similarly to the way Erika has described the way that she's thinking about it. We see this space as one that can carry more economic risk, but there's valuation support here, and it is a good market for stock pickers. So most of our exposure to small cap in the endowment and foundation portfolios is coming through unconstrained managers who can and do predominantly invest in mid cap and small cap. One of the things, I think there's a real balancing act that has to happen here, tying back to Sid, what you talked about on the mega cap and the AI side. We spend a lot of time trying to understand concentration in indices and what our benchmark looks like here. And given the level of concentration we have today in these large cap companies, it's very hard for active managers to be able to be even close to kind of equal weight or overweight some of those mega cap companies. And so what we find is that we want to have exposure to small cap, but we look at our portfolios on a look-through basis. So we look at individual holdings when you aggregate all of our managers together. And what we want to be sure of is that we're not taking a bet to small and mid or positioning to small and mid cap that's more outsized relative to an underweight to large cap than what we think we're doing. Because we do have a number of managers who will opportunistically dip down into the small cap space. So we like that exposure, but we are trying to balance it with also making sure we have plenty of exposure to some of these great companies at the top end of the market.
Sid, maybe turning back to you, this is an area that I know we talk a lot about and have shifted our combined thoughts on the space. But to Sarge's point, a lot of our managers in the large cap space have gone down market cap. A lot of our small cap managers have gone up market cap. Many of them are now technically SMID, going up to roughly 20 billion in market cap. What do you make of this space and how it fits into portfolios today?
I'd say, I think pretty similarly to what Sarge just said, which is that it is a less efficient space for generating outperformance, both long and short, if we're using hedged strategies. I'm very open to this discussion around valuation, and it does appear on the headline valuations that smaller companies are undervalued. I'm just very conscious also of how much we have on a look-through basis from our managers in small and mid-cap companies. And so in this very concentrated market, I think we have to be very aware of that. So that means that the bar has to be a little bit higher for some of the specific allocations that we're making to smaller cap companies, knowing that these active managers tend to be underweight the mega cap tech names. There's a lot of active managers who just say, I'm not getting paid to invest in NVIDIA or Alphabet or Microsoft, or to Sarge's point, I just can't get to an overweight in those stocks. And so with that dynamic going on, if we add too much specific small cap into portfolios, we end up with a kind of unintendedly large bet against AI and tech. So I think it's a balancing act, as I think both of you said, with regard to small cap.
Sid, we've made an asset allocation shift and added to Japan in a lot of client portfolios over the past couple of months. What do you think of Japan today, and are you still adding?
Short answer is I still like Japan. We are still adding to Japan. I like the setup. The stock market appears cheap on a valuation basis. The currency appears very cheap versus the US dollar. There is meaningful corporate governance reform that is leading to rising margins. Fundamentally, over the past couple of years, earnings growth, cash flow growth has been very strong in Japan. And the last 6 months or so, I've been seeking to get to kind of 4 to 5% of portfolios allocated to Japanese stocks through a combination of our newly launched Wellington Japan strategy and a more concentrated strategy that's an activist strategy in a limited partnership structure. So for 20 years, we had almost nothing in Japan, and we were very comfortable with that. I think it was seeing the valuation story, seeing the real shift in corporate attitudes, the openness to shareholder activism, and actually the inflation picture has helped as well, because Japan was mired in deflation for multiple decades. And so the return of inflation has been very good. Wages are rising, consumer spending is increasing because you no longer have this issue of, oh, I don't need to buy this thing today because it'll be cheaper tomorrow. We have a more natural dynamic there. Sarge, you didn't hit on in your opener some of the news articles that we've seen about endowments selling private assets in recent months. What are you thinking about private markets right now? How are you approaching it? And what should we make of these headlines?
Good question. First, just in terms of our approach to private markets, we believe that if we can get access to some of the best managers across a variety of private strategies, venture capital, growth, buyout, real estate, credit, that we can generate higher returns from this cohort than we would be able to do in public markets. There is opportunity for very big wins in areas like venture and just a ton of self-help that groups in areas like buyout can consistently deliver. So we think it's an important part of an asset allocation strategy for our clients. There is quite a bit of illiquidity attached with this part of the market, as everyone knows. When you invest in a private fund, you're typically locked up for 10 plus years. And what we've seen over the past few years, particularly with the slower exit environment, is that time frame is actually getting extended. And so it can only be so big within a balanced portfolio. Typically, we're targeting 10 to 20% for our clients, but it's very client specific and driven by their liquidity needs and their comfort with that level of illiquidity. Just one last comment on our approach is that it's very hard to time private markets. You are making commitments, not investments, when you commit to these funds. They are calling that capital over a period of years and investing it and then harvesting it over another period of years. And so an ability to look at today's market and say, I think today's a great day to invest in privates. This is not something that's easy to do. So we build commitment plans. We work very closely with our private equity team here at Brown Advisory and try to understand what that pacing would look like, and then try to stick to those plans so that we're not taking vintage year risk within the private portfolio. To the first part of your question, with some of the big endowments selling a couple months ago, both Yale and Harvard were in the news for selling portions of their private portfolios. I don't have firsthand knowledge of the ins and outs of the logic behind that, but I can speak to the university endowment space just more broadly, given my background there. These groups tend to have a significant amount of their portfolios invested in private assets. Often see kind of 50% plus of these portfolios invested privately, another large chunk that's already committed to future capital calls and private equity vehicles. As we have seen some of these issues impacting organizations that I talked about earlier, those are happening in spades to some of the largest college endowments. So things are sort of changing on the revenue and organizational side for them where they may need more liquidity, and at the same time that they're getting fewer distributions from their existing private managers. So the idea that some of them would be going to market to sell some of this exposure broadly to improve liquidity, and then maybe more specifically around what could come out in a tax bill where gains on some of these investments could go from 1.5% to as high as 21%, it makes a lot of sense that they would be looking to shed some of those assets. The way that we would think about that is because we do not have that level of private exposure in our portfolios, we can be more opportunistic. And we work with secondary managers who are working with or finding private exposure that either the LP or the GP is looking to sell. These are typically later in their life exposures. We're able to invest in those secondary funds and get access to sellers of private equity. And so we are constantly working with secondary firms. Our PE team does a great job of covering that space and building relationships there. And we would look at this as an opportunity. If we did see more sales coming from some of the largest institutions, perhaps there'd be an opportunity to buy into some great managers and funds on the private side. We haven't seen that so far, but that's an area that we're monitoring.
Sarge, maybe shifting gears a little bit, you've been spending a lot of time with fund managers and investment strategies recently. What are some of your key takeaways from those conversations? And are they thinking or saying anything different than what we've talked about today?
Yeah, I'd say it's been a bit of a mixed bag of reactions. On the public side, and in terms of managers that I've spent time with on the public equity side, all of them are really sticking to what they do. We've seen sort of varying levels of leaning into markets, particularly in April with the sell-off around those initial tariff announcements. And so I'd say we are seeing people trying to take advantage of opportunities that have popped up from a valuation perspective over the past couple months. And at least the meetings that I've been involved in, we're not seeing just wholesale leaning into markets, leaning into opportunities, taking up exposures. And I think one of the reasons for that is if you think about the issues that are driving markets currently, whether it's tariffs or tax policy or geopolitical events, and how those might impact inflation or the labor force or the economy, it's very hard to model these things because they change and sometimes they change from day to day. And so I contrast that to a period in the March, April period in 2020. COVID was clearly unprecedented and just in what it did to the economy. But we found that our managers were able to pretty quickly model in worst case scenarios for what happens if this company generates almost no revenue for a year or however long it might be. And there was a significant sell-off in markets, and we're able to lean in pretty heavily, and we were able to take up our exposures with them. And I think this has been a little bit of a different period just because we just don't know what the outcomes will be around tariffs and taxes and immigration policy and a number of other things. So I think we're seeing some opportunism, but maybe not as much as you might expect. On the private side, I'd say it's been pretty similar, that managers are really kind of sticking to their playbook. If they are good at taking costs out, and it feels like that's the environment their companies are in, then that's what they're doing. I would say that the idea that 2025 was going to be a much bigger and more healthy year for distributions through things like IPOs and M&A, the feedback we're getting there is that that's probably delayed, at least at this point, unless you're in the AI space, maybe defense and some other kind of specialized manufacturing areas.
Maybe to close things out, we could go around the horn and talk about what we're doing in portfolios. Erika, let's start with you. What are you up to?
Yeah, we haven't really talked about the yield curve yet. So should the Fed cut in the back half of the year, we could have a steepening of the yield curve. And so concerns over a rising deficit has led to the long end of the curve, with 30-year rates going above 5% for the first time since 2007, really responding to that rising government debt. So the deficit, rising Treasury issuance could reinforce or push up long-term yields. So we're spending a lot of time thinking about that stability bucket, fixed income. It's a balancing act. In many ways, your core fixed income right now, and Sid, you mentioned this, it's been pretty volatile. And in drawdown environments, our fixed income portfolio hasn't necessarily participated in the stable way that we would have wanted, just because of that significant volatility that we've seen in the curve so far this year. So on one hand, clipping the coupon for core bonds and also thinking about them as a recession hedge. But today, real return after inflation, it's pretty good, but we want to maintain quality and we continue to have shorter duration. But, we've looked in other areas and we've got exposure to securitized, keeping short duration while generating yields that are kind of above investment grade. We continue to like private credit where there's consistent cash flow and yield. We also like infrastructure. We think that those type of strategies are positioned well in this type of environment. And within equities, we continue to have a tilt towards value equities focused on areas outside of U.S. large cap. And both of you talked about the reasons for this with the weakening dollar, but we've really seen this shift by investors due to a combination of attractive valuations, exposure to more cyclical areas internationally, like industrials, energy, and financials. And we also have increased fiscal spending overseas that'll take time, but it's definitely having an influence on investors' mindset and investing abroad. So a big thing that we're doing is reviewing weights in client equity portfolios versus a global benchmark and just making sure that we're close to targets on an international side. But then at a high level asset allocation, really making sure that we're at targets in equity and fixed income asset allocation perspective. And then something that we've done all year is rebalance. Rebalance coming into the year by trimming equities, rebalanced in April by adding a bit to equities, rebalancing now, but we're very focused on our fixed income portfolios. Sarge, I'll ask you the same question. What action items are you taking in client portfolios right now?
On the manager side, it's been a reasonably busy year in terms of new investments. Sid mentioned alpha extension strategies. On the hedge fund side, we've piggybacked on some of the work he and his team have done there and have made a new investment in that space in 2025. A couple other new relationships for us on the manager side in the US, one more large cap, one in the small to mid cap activist space, and then one in Japan as well. This is a market that I've been invested in for a couple of decades at this point and support everything Sid said there in terms of the changing dynamics in Japan and the opportunities. So we were able to make an investment with an activist manager in that country opportunistically after the sell-off in April. From an asset allocation perspective, we continue to be overweight. So non-US is a trade-off to being underweight here in the US, overweight small cap, continue to have a bit of a value tilt in portfolios and have a healthy level of duration in fixed income portfolios, but staying a bit below our benchmark, the ag in that space at about 5.5 years for most of our clients. We have not made material changes to that asset allocation in 2025. We have made some changes on the edges here and there, but continuing to stick with what we have there. Sid, why don't I kick it back to you to close out and talk about what you're doing in portfolios?
Sure. It rhymes with what both of you said. But other than the things I already spoke about, increasing exposure to these passive plus strategies, increasing Japan, I just wanted to dovetail on your private conversation. I'm pretty passionate that we're getting to a point where the supply demand dynamics in the private investment world are tilting in our favor. Fundraising is down substantially. Some endowments, at least at the larger end, are seeking to sell assets. And when we look at the ratio of dry powder, uncalled capital to the amount of invested capital, it's really low. I mean, decade lows. So I'm really trying to stay disciplined on making investments in the private sphere. Sarge, you mentioned secondaries. Secondaries, I believe, will have a bigger role in this next few years as there's so much illiquidity that needs to get pumped out of the system. So we've been certainly prioritizing allocations there. And then I'd say big change is following the Liberation Day moves when those tariff rates looked like they were going to send us into a recession. I was reducing exposure to credit. I was pausing commitments to areas like semi-liquid private credit and focusing more on distressed allocations. I'm still focusing on some of the distressed allocations. I think some of the things Erika talked about, supply chain pressures, there will still be companies that are disadvantaged by tariffs. And I think there are going to be individual companies and industries that'll present distress. But I'm restarting or unfreezing allocations to areas like semi-liquid private credit, where I think you're still getting, a 10, 11% net yield, which is very competitive with what we're looking at for our long-term equity returns. And if I think we're in a more normal environment with maybe a slightly elevated recession probability, but not what we were all staring at a couple of months ago, I think we can go a little bit more back to business as usual, as long as we're partnering with experienced investors with long track records of conservative underwriting. So I'd say that's one of the bigger shifts, is kind of unfreezing. Well, thank you all for joining us. Thank you, Sarge, for joining the pod today. And thank you all for listening. We will see you next time.